Today I get to introduce Mark Van Mourick. I'm going to do that in a second, but first I want to just make sure that you know about Convene a little bit. If you haven't met Convene, we'd certainly love to introduce ourselves, as we are a gathering of Christian CEOs. Today we have about 500 CEOs and business owners who help each other excel. They propel each other towards building better businesses, increasing leadership success, and having greater kingdom impact. So if you'd like to learn about that, after this time, please give us a call, and we'd certainly be happy to talk through the opportunity to have a coach of your own and a team of your own. But today we're gonna focus on financial freedom. This whole idea of God gives us things to steward, and in the midst of that, He gives experts. He provides expertise to help us do that. And so you get to see a picture of Mark there, who is this awesome man who has been deeply involved in the world of finance for over 36 years. He is a long-term expert. How do I plan for the long term? How do I find financial freedom so that I can give more of my time as my time moves towards retirement or really different interests? He has lots of different interests going on there. He has an exit planning group, which is 7 different disciplines, which we'll get to learn about on a different webinar in the future. But today we're going to talk about how we discipline ourselves and take care of our money. Mark is a long-term Convene member, over a dozen years. He handles 36 wealthy families and helps them navigate their financial interests. And so what I love is, I was talking to my wife about this morning. I was saying, you know, gosh, the principles that Mark is presenting, it's that thing of taking complexity and making it simple, and that is a gift. And so I'm proud to know Mark. I'm honored to introduce Mark, and I know you're going to learn some great stuff today from him. So let me get out of the way. Mr. Mark Van Mourick, take it over and give us some of your wisdom.
Thank you, Mark. Just in way of a background a little further, I started off in the financial services industry at Smith Barney, and I rose through the ranks pretty quickly there. And I left in 1987 to start my own firm. I had 1,200 accounts, and I took just the top 12, and now we're up to about 36 families, as Mark mentioned. Along the way, I've had the privilege of working with some very successful people, and I learned a lot myself. I will be transparent throughout this about some of the lessons I've learned, and I don't want to say that I've got all the answers or that I've done it perfectly. In fact, you'll see some mistakes I've made, but I have learned quite a bit, and I think the lessons I've learned have proved out pretty successful here, as you'll see. The whole question Mark Ottestad and I have been going back and forth with about retirement is it a biblical principle? Is financial independence really a worthy goal? And I think what you'll see throughout this talk here, that whether you decide to retire or not, which really wasn't even in our vocabulary before the 1950s, having the ability to have financial freedom sure gives you a lot of options. Just like having great grades in school, you've got lots of things that you can do when you get out. But we'll get into that as we go. But the idea, the lasting impact I want to leave with you is the idea is that instead of you working for your money, to have your money working for you, and then you can have freedom to do your callings or other things. Let me just get into it here. This is our firm, Optivest Inc. We're down at Dana Point, and we have accounts across the country. We also have an investment banking wing. We help businesses sell their business. We do retirement services with insurance and annuities. We also have a large real estate department. But today we're going to talk about successful retirement planning and how to get started. And here's the agenda for today. In a moment, you're going to see some questions, just 3 questions I'd love you guys to fill out and give you a couple of moments for that. And I'll see, it's just really the questions are going to be about who's here, so I can tailor the talk better. We're going to talk about the rat race. We're going to talk about how to build an optimum balance sheet, and then how to do a proper retirement planning. We'll wrap up and then have time for question and answers. So if you would just take a few minutes or less just to answer these quick questions so I know who's here, your approximate age, Do you plan on selling a business in the next couple of years, and or if you are planning on retiring in the next 5 years? So I'm going to keep going here. You guys can do that on the sidebar, but that'll help me as we go through where to emphasize different topics. Well, let's just jump right in. The rat race. This is a great slide just showing a typical worker. I feel like we're on the treadmill. We earn it, we spend it, we earn it, we spend it, we earn it, we spend it, and it just feels like you're never really getting ahead. It's a stressful lifestyle. There's no security. You don't have savings built up. There's no margin in your life, and unfortunately, you never get ahead. Let me show you what that looks like graphically. I've been working on this. Usually it's a chalkboard slide, but it's on the left-hand side here is your earnings over the years, and the right-hand side, the bottom portion there is time. And you can see in this slide that the red graph, the red line is your earnings over time that hopefully go up, and in this example they do go up. And often though people, as their earnings go up, they increase their lifestyle. And in this first example here, you can see the guy gets a raise, and then he starts going to Starbucks. The next time he gets a raise, he starts going to Nordstrom's. The next raise, he buys a flat-screen TV. The next raise, he buys a BMW. The next raise, he starts staying at the St. Regis instead of regular hotels. But at the end of this extended period of years, he's still drinking coffee, still wearing pants, still watching TV, still driving a car, still sleeping in a hotel room, and is still broke. He really has not gotten any further ahead. His lifestyle has crept up and has taken every inch of the raises that he's got over the years. And I'm sorry if I use he instead of she. It's just the quick go-to here. If you are a fortunate business owner and you spend your entire career doing this, and at the end of this road on the right-hand side, you sell your business and you cash in for however much, and then you can retire or have financial freedom, that's great. But there's no plan B, and there's no margin for the hiccups in life, or giving or paying down debt or anything else, because you are spending everything that you are earning. Let me tell you just a couple of quick stories about people that have done this. This was me up until the mid-90s too. I mean, I was on a fast career. I was earning lots of money, and I was spending every bit of it. I was increasing my lifestyle. I was buying fancier cars and houses and second homes. And every time I got a bump, I was right there spending it. And then the mid-90s came, and there was a downturn in the real estate business we're in, and I went 11 months without a paycheck, and I said, I am never going to go without margin this again. I also was not in a position to be giving back then. I had a doctor come to me a few years ago. He wanted to retire in 5 years. I said, great. And I knew he had this big house in Nelligales, which is a nice community near us. I said, let's see what you have. And so his house was a couple $1 million, but it was fully mortgaged. There was only a couple $100,000 of equity in the house. He had about $75,000 in his IRA. He was earning $400,000 a year, but he was spending all of it. And actually, he was coming to me because things were tight, but he wanted to retire in 5 years. So I shared with him what it would look like to retire in 5 years. You have to sell the house, move to a teeny condo. You're going to sell everything that you don't need. You're going to invest the money. You're going to have to live on maybe a quarter of your earnings and save the rest. And after 5 years, you will retire in that modest condo. I would ask the audience at this point if you think he would do that, and the answer is obviously no. He didn't do that. He will die in his practice, and it might be his wife's problem. But it's just amazing how if people wait too long to do this retirement planning, it just is too late. Another businessman story, we had a man that came in that was very successful, but his business had just had a small downturn, and he was having trouble meeting cash flow, so we went through his finances. And I came back with some recommendations. I said, well, how about selling the big custom home and moving to a smaller home? So I could never live in a track house, he said. I said, okay, well, how about the cars? How about if we, you have those brand new Mercedes. How about if we sell those and go to something smaller? He said, we had an accident a while back, and I just want to drive the safest cars. I said, okay. What about your private schools that your kids are in? Could you back those off and have them go to private or public for a while? He says, oh no, that's got to be important. You know, the public schools just aren't going to give the same education. And then I said, well, clearly your yacht, you could sell your yacht and reduce your expenses there. And he said, no, you know, the clients that I'm afraid I would lose my clients if I didn't take them out. Well, unfortunately, the end of the story is that instead of backing down one or two things, he ended up losing all of those because he waited too long. But there's just no margin in these two people's lives. And let's switch to kind of a solution here. This is let's get to the next slide. This is what, how to get out of the rat race, how to get out of that earn it, I spend it, earn it, I spend it. And that's that left-hand side of the slide is the same as the one before. But let's take a look at the blue line here, which is the amount of your paycheck going toward living expenses. And you can see in that first portion here, it flattens out instead of going up. And in that case, the person just did not increase their lifestyle at all the next time they got a raise, and that created a little wedge of some margin of earnings. The next one, you can see actually the curve is turning down, and that's because they took the next raise and they paid off their car. Just a simple thing, but now their monthly expenses are lower, and so they've just created this wedge of excess cash flow. There's only really three things you can do outside of spending it or tearing it up with excess money. You can pay down debt, you can buy income-producing investments or other kinds of investments, and you can give your money away. And so those are the three things we're going to be talking about doing going forward here. But you can bend that expenses, the portion of your paycheck that goes to living expenses, you can continue to bend that down. You can pay down your mortgage, you can pay down other debts, and you can balance that with investing in cash flowing investments that throw cash flow to you every month, mailbox income we call it here, and that would contribute to that line going down. It can go below zero. It's interesting, but in my case, I crossed this line about 10 years ago where after about 10 years of paying down debts, of saving, of investing in cash flowing investments, I have about 50 K1s, which is a pain in the rear when it comes to tax time, but I get almost 50 checks a month in the mail that contribute to my personal expenses. We crossed over about 10 years ago, and today we are deep below the line. We've got tons of money coming in passive, whether I work or not, but my entire paycheck then, you can see here, is available for either further debt reduction, which I've got 4 homes, I just have a mortgage on 1, and I'm trying to pay that down as well, pay it off. And I continue to buy income-producing investments, but I'm also giving away half of my paycheck to charity, and we have a foundation, and we've been very active with that. And we wouldn't have anything like the freedom to give half our paycheck away if we hadn't have done this. Now, this takes time. It shows here 20 years. It probably will take time like that if you continue to get raises and are aggressive at savings and paying down debt. You can do this. I took about 10 years, but the next 10 years were very fruitful because we just had tons of freedom in our lives. The other thing I will point out here, think about how much better a business person you can be if you are at the end of this graph, having all this available cash flow. You could make investments in your business without taking a paycheck. You can make better business decisions because you don't have to kill that last, you don't have to make a more aggressive sale than you would, unconsciously do. At any rate, I think you're in a much better position to be a giver. You can be more generous, in all sorts of manners, and it just gives you a lot of margin in life. So part of this, though, is up to you. You have to be the saver. You have to plan. You have to also do it over time. So just a quick couple of stories here. The doctor that couldn't retire, or tried to retire in 5 years, the businessman that had to cut back, lost it all. The other thing here is the cars. If you buy a new car every 3 years versus paying one off and keeping it, there's tens of thousands of dollars available for reinvestment at that point as well. It also is a snowball effect. If we go back to this slide, the bigger the wedge is, the more money I have to throw at debt reduction, the more money I have to throw at income-producing investments, and it just snowballs. It just accelerates how fast you can get out of the rat race. So let's assume that you're closing in on retirement, and let's talk about what your balance sheet looks like. On the left-hand side here, we have a traditional balance sheet where you've got your assets on the left side, your house, boat, cars, everything that you have, investments. On the left side, under asset and under the liabilities column, you simply have your mortgages and all your debts. And this type of balance sheet is fine while you're working, but when you retire, the problem is you need to have it look like the balance sheet on the right-hand side, which is what it actually is. You have income-producing assets, which are those listed on the left-hand side, and on the right-hand side, the things that you thought were assets, houses, boats, planes, cars, are not really assets. Those cost you something every month, and you've got mortgages and credit cards if you do. House will probably cost you, even if it's paid off, 2% a year. And if you have a boat or a plane, RV, sometimes those can be as much as 10% a year. The idea, though, is that the assets on the left-hand side have to produce enough to pay for the liabilities and the assets on the right-hand side. And if your ratios aren't right, this just simply won't work. This traditional balance sheet will work if you are still employed and having to feed your balance sheet with cash flow, but it won't work otherwise. This is what an optimum balance sheet, we call it OptiVest balance sheet, looks like. We've been doing these for wealthy folks over the years, or just even anybody approaching retirement. This balancing this, getting this right at the beginning is one of the most important things I help folks with, because if this is out of line, it just won't be successful. So again, on the left-hand side, you have income-producing assets. You've got a diversified portfolio of securities. You may have annuities. You've got income-producing real estate, trust deeds. You've got other income-producing investments on the left side, and those have to produce enough money so that you can pay for the income-consuming assets on the right side. And on our optimum balance sheet, you do not have a mortgage. My suggestion is that when you're 10, 15 years out from wanting to retire or have this financial freedom, you actually, instead of jumping to that next higher house, you take a look at the current house you're in, see if that will meet your needs until retirement, and try and pay that off between then and retirement. If you have got 10 years to retirement, I would suggest you put your mortgage on a amortization that would pay that off by retirement. You might have to right-size when you get to retirement. In this case, I'm suggesting that you have assets, income-producing assets, about twice as much as you have income-consuming assets, which in most cases are your home and your lifestyle about that home. If you end up, let's say, at retirement with $1 million in investments and $1 million home, and you try and retire on that $1 million of investments in that $1 million home, it's going to put way too much stress on that $1 million. You're going to have to get 10% a year on that to support your lifestyle around that $1 million home, and it just is unsustainable in today's interest rates. Better to have at least 2 to 1, and if you can't get that ratio when you retire, my suggestion is you downsize your house till you're at least in that 2 to 1. 3 to 1 is even a better ratio. If you had, for instance, I'm using numbers just to make them round. These may be above or below your situation. But if you had $3 million in investments and $1 million home and a lifestyle around that, that is quite sustainable. Your investments only have to make 3 or 4% return, and that's something that your assets should grow over time. So that's sort of a visual, if you can, if you've got a retirement target out there, that you try and pay your home off by the time that you retire. If you try and keep that home from being larger and larger, so that ratio is in that 2 to 3 to 1 by the time that you do retire. Saving up is also important, and also paying down debts so that your income-producing assets in retirement will pay for your assets on the other side. Just a couple of recaps here. The first part of our conversation was about getting out of the rat race, trying to create excess cash flow to go to your living expenses, debt reduction, buying income investments, and giving. And just on the right-hand side, these are all biblical principles. We've learned about not being a slave to debt. The second one is being a good steward, the parable of the talents. And the only place in the Bible God says, "Test me in this," is in Malachi, where he challenges us to give, and that we will get tenfold, hundredfold back. Our Optimum method here is this, trying to create a balance sheet of 2 to 1 at least to retire on or have that financial freedom. The investments are something we can certainly help you with. You need to be doing the planning. You need to spend less and save and pay down debt to get yourself in a position where you have funds available to invest. But we've been doing that for, 28 years as a company, and I've got a great staff here. These are some of the investments that, kind of the toolbox that we would have for investments for families that are retiring. And the portions of these that would be appropriate for you is all individual. And so I'm not going to spend much time on this slide because they're all a little different depending on your individual circumstances, your risk tolerances, other assets, and things you have going on in your life. But we would, if you have an interest, we would love to sit down and talk to you. In fact, I'm going to offer here to the listeners a free 1-hour consultation if they have an interest in talking about their investments and helping plan toward retirement. We're happy to sit down for an hour with you and spend that time with you, whether it goes to an engagement with us or just helps you move along further. We're happy to do that. Just a quick wrap up before we go to questions and answers. I suggest working to get out of the rat race. It's a stressful place, and I assume some of you have been in that place if you aren't still there. The other kind of thought is when you're young, you can invest aggressively. It's a cruelty that you have less to invest, but you do have time. And so if you are young listening to this call and have 20 or 30 years to retirement, I would suggest investing quite aggressively in your retirement plans. But as you get into the last 10 years of retirement, you don't want to end up trying to retire when the stock market is down 50%, so you need to back off and have a more conservative plan in those last 10 years. I would suggest don't buying a house that you can't pay off before retirement, and consider waiting to retire until your children's and your parents' needs are met. This may seem obvious, but it's obviously a lot easier to retire once your kids are fully launched and your parents aren't needing your funds for support. That's kind of a wrap up. If you have an interest in, I also wrote a book on this, on selling your business, building an optimum investment portfolio, and other issues about retirement and successful living off your money. If you're interested in that book, you can buy it on Amazon, but I'm happy to send you a free copy if you want to contact me at my email there. Also, again, you can reach us out there, and we can schedule you with Shannon in our office if you want to have a free consultation. So at this point, I'd love to open it up to questions.
Well, I certainly have a couple, and I would always start with this idea that Mark gets it, and he displays it by his own generosity and by his foundation. And last time I talked to you, I think you were getting ready on an airplane to go, enter into a world of helping folks in a third world country. But when I listen to you, I wonder, can you just tell us the difference between managing one's retirement assets through a broker versus working with an organization that's structured such as yours, which would be, I guess, a private wealth management firm?
Sure. there are the banks and the brokerage firms mostly work on commission, and they use often loaded funds. Some of the banks can get some of the no-load funds, but they also charge pretty high asset management fees, the combination there. A fee-based planner, an investment advisor that works on a fee base and uses institutional no-load funds is just going to be or managers just is a lower price format for folks. And the management fees add up over time. If you're paying 1 or 2% management fees, those can really cut into earnings, particularly in today's low interest rate environment.
Yeah, so, my entry into here is always, I find it difficult because there's so many variables. So when I talk to financial guys, I'm always a skeptic because of the variables. And now we have two variables, one being inflationary tendencies, and now there's all this talk about deflationary. And can you talk about those particular pieces? What are you recommending to advisors or to clients today for retirement with those kinds of influences right around us?
Yeah, it is interesting, and I don't want to launch into a whole discussion about the current economy, but there are a lot of places around the world today that are right on the bubble of deflation, and of course Japan's been on it for 10 years. We all remember the high inflation of the 70s and 80s, and that's kind of in the back of our brain. But I don't know that those two extremes are likely in our at least immediate future. But you do need investments that will be okay in both. Most of our portfolios are very well balanced, sort of a yin and yang. We've got 26 different asset classes that are designed to really protect you in downturns. They worked well during that 2008 downturn and recovered quickly, and I think we've got a good handle on balancing those risks. Obviously, we can tweak them if interest rates and inflation are going up. You're going to want more inflation-sensitive investments. But the deflation is a scarier animal, and we've got some tools that would help against that as well.
Yeah, so kind of my final thought, if anybody's got a question that they want to post up, you can certainly do that. But the final piece, in the convene world, I think there's this idea of business excellence. There's this whole idea of generosity and giving. And so what about Optivest with regards to helping investors with their giving, with their, how do I do that? So are you centralized in that space as well?
Helping in one of the things that we kind of model here is at least how we give ourselves, and we have an interesting corporate model. We've got 5 different divisions here, but we take 10% of the gross off all the top line and put that into a foundation and give that away every year. And if people are interested in seeing at least the organizations that we do it, that's optivestfoundation.org. We are in the third world weeks every year. We just got back from the Dominican Republic, taking 7 of our staff down there. Often we take clients with us. So we love to engage people in those conversations around our passions are mostly outside of the country. I know a lot of people's passions are in their own communities, but we're prepared to really help engage in those conversations and help people dream about what they can do in those regards.
I love it. So we do have one question here that I wanted to make sure you heard. So what are some of the strategies to get yourself in a position of being self-insured rather than getting trapped into paying out high premiums at and in retirement to balance risk?
Okay. Well, I'm taking this as there's a couple of, it sounds like an insurance question, and to me there's 2 places for insurance. One is to ensure the cash flow of the breadwinner during the years that your family is most dependent on your income. If in this example here, I would certainly have some term insurance until I got to that balanced portfolio where I had a 2 to 3 to 1 assets versus liabilities. I would have a term policy during that period of time. Once you're in that financially freedom or retirement spot where you've got 2 to 3 times your your lifestyle assets in income-producing investment assets, I don't think your risk for your spouse warrants having a large insurance policy. The second reason you might want insurance might be to protect your heirs from paying a lot of estate tax. And so that you might want a policy, and I'm happy to talk to you about that, and that goes into how much you're giving your kids versus giving your money away to charities at the end of your life. And those are kind of two different issues, but I do agree that if you do your financial planning correctly, you need much less insurance than you do if you are living in that rat race bubble and have no savings built up.
Well, if you'd be so kind as to flip back to the previous slide so that people have your contact information, and Mark certainly has a spot right there that kind of looks over the harbor. I've been there, it's beautiful, and once again, the privilege of working with quality people that think deeply, have been involved in. Mark knows business owners for sure. He can for sure help you think through, and if his firm is the best, great, and if not, he'll give you some great thinking. So I thank you so much for being a sponsor. I thank you so much for being a friend, and we hope this helps you listeners on your journey of stewardship. And so we say goodbye, blessings to you all, and have a great Thanksgiving.